All right, we will go ahead and get started just in the interest of time. So, good afternoon, everyone, if you are on the East Coast, or good morning to everyone else. My name is Damali Harding. I am the U.S. Program Director and Principal at the Regulatory Assistance Project. And the Regulatory Assistance Project is an independent nonprofit that supports energy regulators in the clean energy transition. This is the third in a series of webinars that we have hosted for NARUC's Workforce Development and Diversity Committee. The first two webinars, how the regulatory process can advance equity and commissioning a next generation workforce, will be either available on our YouTube channel or NARUC's website in the next upcoming weeks, as well as this webinar. And this webinar sprouted out of an idea that I had, which is why can't utility customers pay their bill through Cash App or a similar mobile payment system? In the past, especially in disadvantaged communities, payment systems were interlinked, i.e., somebody went to cash their check at a liquor store and the Western Union was directly across the street. As the digital age of financial technology, or fintech, has shaped up, we presume that it makes it easier for everyone to access and move cash around as they receive it. However, that's not the case. According to a recent Federal Reserve study, 4.5% of Americans had no access to a bank account. And as you look at that lens through a socioeconomic one, that just increases up to 3 times. These numbers don't tell the full story as well of those that are underbanked and may not have access to digital payment systems, for example, credit cards and the like. So, what does this mean as we think about long-term affordability in the energy transition? How can we think through different payment structures to meet customers' needs? Well, to answer that question, I am joined by four amazing panelists. Former Commissioner Obie Linton from the Maryland Public Service Commission, who has currently founded Utility Campus. Kevin Dick, principal at 38NM. Shelby Green, research fellow at Energy and Policy Institute, and Corey Rithaler, principal at Deloitte in their customer programs and power and utility sector. And again, I am Damali Harding. So today's panel each panelist will have about 5 minutes or so to talk, and we are taking questions. So if you have questions through the Q&A function that everybody should see, please put them in there. We have ample opportunity at the end after everybody's presentation to address questions. We will also try to address questions through chat if feasible. But again, if you hear something and you want to have a question, we have more than opportunity for a robust discussion, again, based on what I know about these panelists. And so with that, I am going to turn it over to Commissioner Linton to present first.
Thank you, Damali. And since I'm on the East Coast, good afternoon to everyone joining us today. Thanks also to the Regulatory Assistance Project and NARUC for the opportunity to speak today on this important topic. Molly didn't have to ask me twice to participate on this topic because the reality is that the provision of energy services to consumers has changed a lot since the days of Westinghouse and Edison and Latimer and Tesla on the utility side of the meter. What we don't pay a lot of attention to is the fact that it's also changed a lot on the consumer side of the meter. Now, there's been a number of significant advancements for consumers in the manner in which they can interact with their utility company, and a lot of things have changed. In every jurisdiction around the country, there's been a bit of a pulling back of sorts in some of the services that utility companies used to offer. I mean, there used to be days when customers could walk in and talk with their representatives of their utility, negotiate payments and bills in person, things of that sort. But today, as you know, we have chatbots and we have websites and apps and solutions that are a little more efficient because of the volumes that some companies have, but at the same time are a little less personal. So in the midst of that transition, we've also seen other industries advance in other ways that haven't necessarily made their way into the utility side. And as commissioners, the one thing that every commissioner has in common is that before you were a commissioner, you were a customer of a utility company. So you had a chance to see a bill, you had relatives and friends and neighbors that had bills, and you had an opportunity to interact with your utility company in some form or fashion. So it's easy to feel as though, as a commissioner, you are familiar with how the utility company operates, how the billing system works. And I could tell you here today, after working in the industry now for many years, before I was a commissioner, I served as the director of the Consumer Affairs Division in the Maryland Public Service Commission, where in that capacity, I was there for over a decade, working on behalf of, working in between utility companies and consumers to resolve a wide range of disputes. And the one thing that I learned is that there's quite a lot about how the utility company bills the consumer and the solutions consumers can rely on to pay the utility. There's a lot of processes that utilities rely on that were established in some cases decades ago, and they have not kept in pace with a lot of the solutions that consumers are familiar with today. Utility company systems are and commission regulations are designed the same way, uh, and that's both for good and bad reason. You really wouldn't want those regulations to change immediately, but keeping them in current with today's standards of billing and payment is a very valuable thing because everybody has different ways of managing their money, even if it doesn't make sense to everybody else. It's still what works for one person doesn't necessarily work for someone else. So, as a commissioner, it's important to not only understand the systems that the utility companies use, but at the same time understand the manner in which consumers consume the energy and then use the energy and pay for the energy, uh, or natural gas or water or electricity that they are consuming from the regulated companies that you regulate. It's a continual learning process. And so I'm hopeful today in this panel, for purposes of the payment side of the uh, entire regulatory structure, that we spend a little time, and I know we can spend a little time talking about the manner in which consumers are able to make their payments to utility companies and some of the challenges and obstacles that consumers and commissioners have to face in order to allow that system to work for all consumers efficiently and evenly, and so that it meets them where they are, as opposed to effectively dictating to consumers the best way to make a payment, when in reality, the main thing we want is for that service that was consumed, but also delivered safely and reliably, is also affordable and can be paid for by those consumers that are using it.
Thank you, Commissioner Linton, for those remarks. I'm going to transition now to Corey Rithaler from Deloitte.
Excellent. Thank you, Damali, and thank you for having me on this panel today. By way of a quick introduction, I'm Corey Rithaler. I am a partner at Deloitte Consulting and lead our what we call customer and marketing practice for utilities. I've been consulting within the utility space for about 24 years now, and working with regulated utilities, deregulated utilities, municipalities, and in both the U.S. and abroad. And on the topic of customer affordability, we oftentimes have heard from various customers across or various utilities across the country that when they go out and survey their customers and really get voice of customer, it oftentimes, or I would say almost all of the time, is in the top 2 to 3 concerns and issues of their customer base, with safety also often being right there with it. But what I wanted to share today was one example of something that we developed with a investor-owned utility And Commissioner Linton had mentioned that today utility customers often interact with chatbots and digital products and websites and portals. Well, that's a lot of the work that I and my colleagues do. For this one particular utility, we worked with them to investigate what were those real needs of their low-income customers as it related to struggling to pay their bill. And we found some interesting things in this research. The first was that 70% of the cost for the utilities around their cost to serve were around payment related issues. Those could be exceptions or bad debt and a number of other things. What we also found was that in the investigation of the low income customers, about 10% of their income each month was spent on electricity. And I've also worked with a couple of utilities in the South and in my past where that percentage was even, or in the Southeast, where that percentage was even a little bit higher. And we've really found that limited income customers drive very high call volumes, often lack awareness on what payment programs might be available to them, what funding assistance programs might be available to them. So if we could go to the next slide. One of the things that we developed was what we called or affectionately called Assistance Finder, which is it's in production, a digital product that allows customers to self-serve in a way that with very basic info that they provide about themselves in a guided manner, it allows for that customer to quickly understand what payment programs they're eligible for, provide some automated program eligibility checks, provide personalized recommendation back to the customer on how they can best be supported in being able to pay their bills. And all this is backed by some pretty sophisticated data-driven analytics, access to customer information in core systems. And the results have really been astounding. For the utility, we've seen reduction in calls. We've seen a dramatic reduction in late payment charges, and then also a very large uptick in increased enrollments in funding programs. And then for the customer, the payment assistance has gone up dramatically. In 2023, this particular utility was able to assist customers with about $20.5 million in payment assistance just by being able to connect customers to programs that they otherwise may not have known that they were eligible to enroll in. So, look forward to the Q&A portion, but hopefully enjoyed this. This one example of how a digital tool and capability can help with low-income assistance for payments.
That's fantastic, Corey. Thank you for that. I'm going to transition over to Shelby Green.
Hi, everyone. Thank you all so much for being here with us today. My name is Shelby, and I'm a research fellow with Energy and Policy Institute. Before getting into this work, I actually studied chemical engineering and worked in software development, but got really passionate about energy affordability during the post-pandemic economic recovery period when my local utility started turning off people's power without a disconnection notice. So the title of my presentation is just kind of a little bit of a fun one, I hope. It's talking about utility limbo and how utilities can use flexibility to increase their energy affordability. So this graphic here is hopefully setting the picture of how regulators in many ways are the ones who are determining the bar in terms how customers can actually afford to pay their utility bill, and some of the practices that regulators design can make sure people can comfortably walk through or bend through those through that bar. we'll keep going and talking about this analogy. So keeping the talk about flexibility, but instead of talking about payments, we'll talk more about practices. Just doing a little bit of thinking back, kind of just wanting to re-illuminate some of the circumstances or situations where you would expect or at least require utilities to be more flexible. And I think some people may be thinking about COVID, the global health pandemic, but also times like extreme weather events like flooding, heat waves, or tornadoes. And even in cases where there's infrastructure failing in terms of billing or billing vendor software not working properly and being able to accurately display a customer's amount due. So these kind of situations, I believe this is when flexibility is applied. So traditional utility practices like disconnection for non-payment or charging late fees are suspended due to instability and chaos. And a lot of the times these circumstances are viewed as physical and flexibility is applied as a last resort. But the question that I want to raise here is, what if flexibility was adopted as a standard and not just reserved during times of crisis or disaster? Could this shift in perspective actually result in more effective approaches to preventing or curbing debt, disconnection, and consumers from advancing in the Dunning cycle? And especially, what if flexibility was automatically applied during circumstances of economic instability where customers are economically immobile because of the debt, like is shown here on the screen? This is from a recent report by the National Energy Assistant Directors Association. So moving on, we're going to talk a little bit more about some different standard utility practices where flexibility can be applied to. So the first one here, late fees. I don't think anything that I'm saying is or showing here is radical, but there are a lot of different ways to apply flexibility to increase energy affordability. There are some cases where utilities have a fixed charge of maybe $20, $25. Anytime you're late, that charge has to be paid. And some recent example, this is not just a utility, but actually credit cards through the direction of the FEC have actually had to lower their typical late fee from $32 to around $8, capping that fee so that there's not an incentive to create a business model around late fees. So there's just a spectrum of options that can be applied to extend flexibility in terms of late fees. And another industry that has also looked into this as well are public libraries, where usually they would apply a fixed charge, but a lot of them have gone towards eliminating late fees to increase product recovery. Moving forward. Another typical utility practice is shut-off turn on payment. And all of the flexible options here don't fully show the spectrum, but there are circumstances where disconnections or shutoffs can be delayed because of a circumstance, whether it's physical, economic, or environmental. A grace period is expanded from maybe 10 days to 30 days to allow customers to have a full payment from their employer to pay their utility bill. And also disconnections can be delayed based on a number of required contacts before the process can occur. Another option to apply flexibility for shutoffs is actually to raise what is considered eligible for non-payment. So in some cases, most utilities do not have a minimum shutoff amount. Very recently in Maine, legislation was passed to at least deter shutoffs that are below $50 for the past due amount. Moving forward. Then the last kind of standard practice that I'll talk about is a collection schedule. If you go onto Google and you type in your utility, for example, I live in DC, so I type in Pepco, some of those common queries after that Pepco prompt will be, you know, how much time do I have until I'm disconnected, or how much how long can I wait until I have to pay my utility bill before the disconnection process starts? So a lot of notices lack adequate and transparent and clear information about the collection schedule, from when a late fee is incurred to when a disconnection process is started to when a debt is sent to a debt collection agency. So applying flexibility to the schedule would be to include transparent information. And moving on to the next slide, this is an example of what every utility, hopefully in America, could include on their page to help answer these questions of how long do I have until the next phase of the dunning cycle begins. And that flexibility allows customers to decide, if I have to choose between, paying for my kids' childcare costs versus paying for my utility bill, at least that gives the customer some flexibility to determine, okay, when can I pay this before things are getting too far and putting me in more financial stress. So I hope to talk more about flexibility when it comes to standard utility practices as we get to the Q&A portion of this discussion. Thank you.
Wonderful. Thank you so much for that, anchoring us in that, Shelby. And next, we're going to turn it over to Kevin to wrap it up before we open it up to questions.
Thank you, Damali. My name is Kevin Dick. I'm the principal for 389NM, and I'm former program director for the Delta Institute. And while I was there, I founded a software product for utilities to help low-income customers manage their arrears more effectively, called Light Bill. So I'm going to go through what we discovered in our proof of concept development and where we are now. Go ahead. So we did a lot of user research around how customers not only pay their bills if you are low income, especially unbanked customers, as was mentioned earlier, with IDEO. And we spent a lot of time understanding the current way of doing things. And one of the things that we found is that the process for payment and the process for getting a subsidy seems to be reversed. So we actually give subsidies to people when they're drowning, as opposed to helping them out when they are much more likely to pay their bill. If you remember in the last presentation, I think the average amount of arrearage was $684 or so for some of the electric utilities. And when you get to that point, you're just less likely to make any payment at all. So we wanted to try to develop a way to make it easier for customers to be able to make any payment, and if they couldn't, to get assistance immediately and not have to go stand in line and fill out paperwork and wait a month to get assistance that comes usually too late. Next slide, please. We did a lot of research on when arrears happen and what's likely. And if you'll notice, this is real utility data from a large utility. Most customers are in and out of arrears on their own within 60 to 90 days. So if we can avoid the Dunning's process that gets them to shut off, we not only avoid the pain of them having to go through a shut-off process, we avoid the cost to the utility of doing that. So if we move our assistance further up and make it easier for a customer to make a payment or that is possibly smaller than their total bill, and then if they can't get that payment through entirely, to provide them with a subsidy earlier, we can avoid that cost, which is ultimately borne by ratepayers. If you wait until it's uncollected, it gets borne by the ratepayer. Next slide. So we developed the software to do so. We created instant eligibility check for means testing. Name, address, phone number, last four of social, or date of birth is all people needed. We could instantly tell them whether they are able to take advantage of a subsidy. It follows all the rules of a lot of the existing subsidy programs and uses a lot of different data points to make decisions on means testing. The important part is that it's instantaneous and you don't have to go anywhere. We also then were able to allow mobile payments. We worked with PayPal to develop a proof of concept around making smaller payments more frequently. And then we provided a real-time management dashboard to kind of track all this for the utility as well. And also delivered this over notification services. So rather than developing an app somebody needs to download, you sign up one time on a web app, and you're able to interact with the program as a notification. And it's more of a push notification. Hey, you have a payment due or you're overdue. One of the ways we were able to do that was to get daily data from Green Button and build a bill so that somebody could get a daily or weekly, often as they wanted, notification of their spend. And then we would do a spend forecast based on weather and other metrics to give them an indication of what their bill would be like at the end of the month, so they could plan accordingly. Next slide, please. So if you just kind of click through this slowly, this is what we kind of envisioned as the keep going, as the way that we would go. You would basically see a point at time over the year where a utility customer could not pay their bill, and then we would give them assistance. They would ask for it. There would be a blackout period. So imagine it like a patient care analgesic in a hospital. If you've ever had surgery, you have that button you press for painkiller. That's how we essentially design the service. Eventually, they would level off because they're getting assistance when they need it, but they are also encouraged to make smaller payments more frequently to stay out of arrears or to stay out of deep arrears, and are more likely to keep their bill either in that area where they're not going to get shut off or to pay their bill entirely. And you can imagine how this scenario would play out if left to their own devices. In our experience, we did about 150 customers in a pilot. None of them wanted to be in this situation. We had many people who were just grateful to be able to get the assistance. And in other pilots we've seen around the country, we've seen that people tend to do better if they're provided with assistance and stay out of arrears. So we saw that we would have to pay a total subsidy, but keep going. We would save late fees. We would provide benefit to customers because they have more price salience and are less likely to use energy, and then have savings that exceeded the amount we would spend on subsidies. You can keep going to the next slide. So we followed the FOG behavior model. This is out of Stanford. Motivation, ability, trigger. So designing a software that allows a customer to have control over their bill, and we provide them with prompts, the triggers, to be able to go toward the behavior. And then, of course, the motivation is brought by feeling in control of their paying their bill, being able to do it easily. That's the ability. And then also having that ability to get the subsidy provides them with the motivation to stay on top of the program. Keep going. Easy onboarding process. I mentioned connected through Green Button, but really simple to set up. Go ahead. I'm not going to go through these, but basically this is an example of the notification service for Facebook and WhatsApp. We were able to provide buttons that makes it easy for somebody to move through with mobile or machine learning, and now with really good AI, we can develop, you can develop more fully integrated chatbots that can actually, provide other services. Like we tested identifying refrigerators and over a photo and giving people energy efficiency tips. So anyway, that's me. Thank you for your time.
Wonderful. Thank you so much, Kevin. So we are now at our Q&A portion, and I see one question in the chat, which I'm going to take, and I think to address. So the question is, in your opinion, is it better to embed customer services from within the utility or spin it to a dedicated services data company to manage the analytics and customer relationship? And as we answer this question, maybe also think about what are some of the barriers and opportunities to customer enrollment in some of these programs, right? I think one of the things we've heard multiple times from utilities is that we have programs, we can't get customer to enroll or uplift. And so what are some of the barriers? And I'll open that up to the panel. Anyone wants to go first? Commissioner Linton.
Well, sure. Thank you for the question. So in terms of the some of the challenges to encourage customers to enroll in these types of programs, I think the main component of that is just the overall challenge of educating them about what you're hoping to accomplish with it. They currently don't pay for services in the same way they do with other things they may purchase. Utility services are still billed in a way that it was done pretty much decades ago. You use the service first. When you receive the bill, it's due immediately. We, in the industry, of course, we refer to it as a post-pay model. The idea of paying for an advance is something that's new to consumers, and it requires a different type of lifestyle. I mean, the reality is that, for example, if you want to put gas in your car but don't have money to do it, you can still walk, you can catch a ride with somebody else. There are other ways of moving around. But if you can't pay in advance for electricity and your account is depleted, then you are facing a very different challenge. So there's a different type of lifestyle change that's required, and consumers have to be familiar with that before they move into it. I think it's possible. I think it's doable, but that's a bit of a barrier in terms of understanding what that transition is like. The same thing applies for utility companies as well. One of the other half of the question was just a question of, do you defer some of that consumer management process to a third party, or do you leave it with utility companies? I can tell you that utility companies are very protective of the consumer utility relationship. It's obviously not just part of the rate base from a financial perspective, but there is a safety component to it. If a consumer sees a sparking wire, for example, we don't really, and none of us want a consumer to be confused about what to do at that point. Same thing if they smell leaking gas, for example. We want them to say, this is what I need to do right now. And it's a clear piece of information, something that utility companies spend a lot of time and effort to make sure consumers know. So as a person that's recently tried to run a utility-based company like this, in terms of educating consumers, I can tell you they are very protective of that relationship. And a lot of our deregulated marketers would say the same thing, and I'm sure even some of the panelists here today would say that there's gathering information from companies can be difficult at times, and they have a long-standing reasons for being that way. There's also a challenge from a regulatory perspective in managing those external relationships. I mean, those are not regulated companies. So they don't always, commissions don't always have the authority to delegate or to direct those companies to take certain actions. They may have a contract with the utility, and so the utility may have some authority through the contract, but it becomes very cumbersome if there's a challenge. And as a regulator, we want to require a particular action, but because the customer relationship is managed by a third party, we can't do it. And as a commissioner, you have certain obligations, certain responsibilities, certain entities that you have to respond to, elected media outlets, et cetera, and regulations that we've adopted that have been in place in some cases for decades that are applicable or may not be applicable to a third party. So there's a lot of necessity to help utility companies transition to more modern opportunities and methods for working with consumers and for accepting payments in alternative ways. And I'll stop after this. About a decade ago, a little more than that, when Maryland had a polar vortex event, we received a wide range of complaints from our larger utility companies and very few from our smaller companies. So our commission engaged in a multi-year effort to try and ferret out the reasons for why that happened. And we focused exclusively on the larger utilities and effectively excluded the smaller companies. And by smaller, I'm talking about our cooperatives and municipals. I was tasked to lead that investigation. But even though the commission excused all of the smaller companies, I set up a meeting with them anyway and tried to understand what did they do? Why didn't we see any complaints from their customers, even though they received the same billing challenges, had the same cold weather issues. And the reason why is the very topic we're talking about today. It was payment flexibility. Even though consumers had larger bills, they could walk into the local office, offer $10, and the utility said, "You're fine, we're not going to disconnect your service." And a couple days later, because the consumer was encouraged by that, they showed up and made another payment. And they didn't file complaints. They never contacted the government or anybody else. They just kept showing up when they could, making payments, and the utility company kept allowing service to continue. So there should be an effort to help regulators and utility companies modernize their efforts. And you can do that by exposing all the parties to other solutions that are out there. And especially to consumers, letting them know that there are opportunities and other options out there. I can tell you as a former regulator, we would never want to hear that a utility company is refusing to take a payment from a customer, even if it's a small one.
Thank you for that. I'm gonna move to Shelby now to also address that question.
Thank you. Commissioner Linton was very expansive in his answer. I just wanted to add on and kind of reiterate that the customer has such a familiarity with the utility where most of the communication is being exchanged between the utility and the customer. So I definitely believe in some circumstances, communication and customer relations should be managed by the utility, but that doesn't mean that the utility cannot share information with outside parties or third parties that administer energy efficiency or system programs like heat programs or community action agencies that administer these efficiency programs. And one example that I wanted to share that I talked a little bit about earlier was, in my case, my local utility that serves about 200,000 customers. When they started disconnecting customers for non-payment, there was every bill received either digitally or through the mail also includes a newsletter. And nowhere in that newsletter was there any information about, this is, you can call 211 to get information about energy assistance programs. This is the state program that's offering over $1 billion in rental and utility relief, or these are the different processes that are going in place. So I think in addition to software and physical or digital infrastructure that utilities need to improve, there's also this communication infrastructure. Utilities need to be more direct and frequent in terms of just talking about, in whatever interaction that they have with the customer, whether it is a disconnection notice or it's just a bill or a regular newsletter, talking about the availability of opportunities for programs and assistance so that customers are regularly getting that information.
So I'm going to move to Corey because you talked about enrollment and uplift in programs that you're helping utilities do. And so what are you seeing as some of the barriers as well? And I think one of the things that was on your slide, you talked about utilities don't do a good job communicating, which I think Shelby just reiterated that even in the disconnection notices, they're not doing a good job communicating. What are opportunities for utilities to communicate better to customers and reach customers to help increase this enrollment?
Yeah, I mean, it's a great question because it's a difficult topic. A difficult topic because there's so many different payment assistance programs that are out there, and I think the challenge that we see across the country is that most countries or most customers don't know where to go look or how to go find what programs they're eligible for, or what even just basic payment programs their particular utility may offer. Some utilities offer pay as you go, some offer levelized billing, some offer budget bills, and these some are good for certain customers, some are not good for others. And what we work with utilities on is creating or doing a couple things. One, the single best time to educate your customers is at the point of enrollment. Oftentimes, people don't think about that, but creating a welcome packet and educating customers on everything that a utility offers is where you have their mind share, or when you have their attention at its peak. The other thing that I would say is, and it gets back a little bit to the root of the question you'd asked before around, should it be the utility that owns the relationship, or should it be the or should it be a third party? Especially low-income customers that struggle to pay their bills, they're looking to engage and develop a relationship with a utility, when a utility does a good job of creating a personalized set of offers, or a personalized payment program that meets their needs. So I mentioned with this one success story, but we've seen successes that many other places, is when you gather some basic information about a customer and be able to tailor a certain offer, whether it be light heat for one or a payment plan for another. Being able to do that on a customer by customer basis will increase the overall engagement in the short term, and in the long term, it will instill trust in the customer, in customers ongoing.
Wonderful. Thank you for that. We have a question, and we actually talked about this, I know, in our preparation call around fees for payments. And so I'm going to turn to Kevin. I know Kevin's answering that more in depth in the chat, but I'm going to turn to Kevin to start the discussion, because I think that discussion also led to us really talking about barriers and opportunity for utility infrastructure into alternative payment plans. And so to kind of come back to my original question that kicked this off, which was, why can't I pay my bill through Cash App or Venmo if I can pay my Uber Eats bill, if I can go to, get my coffee and scan and pay it through my Cash App? Why can't I do that with my utility bill? And what are some of the barriers for that? And so I'm going to turn that to Kevin to start.
Yeah, we did a lot of research on this as well, and I worked with PayPal closely on this topic. PayPal owns Venmo, and together those two kind of cover probably about, I think it was at the time about 60%, it's probably higher now, of the mobile payments. They're licensed money transfer associations, I think, and I can't remember what the acronym is, but basically they're licensed at the state level to essentially take money out of banks and then transfer it into the hands of customers. And the thing that we found most interesting about working with them is, if you're unbanked, you have kind of two options. You have those mobile payment options, and you have prepaid debit cards, which if you lose the prepaid debit card, you lose the cash. So prepaid debit cards, we found, actually had fees associated with them, usually around $2 to $2.50 for making that transaction online. We also found going in person to checks cashiers was usually about $1.50 to $2 to make a payment in person. And we found that bank customers basically could make payments for free. But when we dug into the research on what it costs to cash checks and to manage bank transactions, obviously automatic payment is very cheap. Usually ACH costs are, at scale, 15 to 25 cents a transaction, or even possibly lower. But having the people to manage the check process, the mailroom, all of that kind of adds up to, we found an average around $3.10 per transaction. So my kind of point around fees is, a lot of low-income customers have to pay fees directly because they have no choice. They're unbanked. Many of them are unbanked, not all of them, obviously. And they can't be banked because a lot of banks won't allow them to be customers, because they don't find them valuable, and they're allowed to do that. So we're covering the costs for upper income customers as a matter of course, and we're not covering the costs in many cases for low income customers to make transactions. They're paying that out of pocket already. And so we have seen that change. Illinois started allowing PayPal and other. I think ComEd does that, and it's covered. The fees are covered. I think California does as well. So I think there are places in the country where this is becoming more common. But the point that I made in our pilot and what we sought to look for was really looking for the total cost and not looking at the transaction cost of the payment vendor as kind of how we decided whether or not something was cost effective. It shouldn't cost a customer money, in my opinion, to pay their bill. No matter how they want to do it, you should not be charging them to give you money. That's how I view it. And I think that there are many ways to look at that, but I think it should be as easy as possible for a customer to pay a bill, whether they're driving up to your to a vendor to to with a roll of quarters, or they're using a mobile payment, or they're using the banked app. We should be covering the cost of that, because most other locations cover the cost of that. It's kind of unique in the utility space to see a direct charge for or a direct fee for that. So I'll stop there and kind of let any additional comments that the group might have.
Yeah, I would love to hear from any of the other panelists about potential utility infrastructure barriers. So Commissioner Lynn, for example, I know you talked in the beginning of your remarks about how legacy systems and utilities and how they've been there, particularly for the regulators. What options could they look at or help work with utilities to think about to come into modern era?
Sure. Well, first off, the first thing regulators can do is become very familiar with the systems that exist currently. And they obviously are familiar with being a utility customer, but they do need to become familiar with the regulatory challenges that exist in trying to make this type of change. Utility companies, as we all know, don't pay for anything. So the ratepayers will pay for any changes to legacy systems, the training for new employees, all of the other things that have to be done in order to accept a new form of payment, including training employees. All of that has to come out of the pockets of the ratepayers that are going to be receiving that benefit. So before regulators are comfortable moving forward with something like that, they have to understand and be comfortable in knowing that it will actually be beneficial to all consumers. And that typically becomes part of the challenge. Many of the low-income customers that would benefit from these types of improvements they're effectively a smaller amount of the residential total customers that make payments. Quite a few consumers have their accounts on file with the utility company. The utility just debits their checking account, and so there's already procedures in place that the utility companies know and rely on. We're creating these solutions for a subset of consumers that's going to require different regulations, different practices, and different changes for the utility companies. So that is a challenge, but it's a challenge that can be met if consumers are thought of as being part of the overall whole, and commissioners are comfortable with learning more about exactly how those consumers make their payments and what their practices are. You have to understand the lifestyle, if you will, of a consumer that has to make a decision between paying for food and paying for their electricity bill, or paying for medication and their energy bill. So when you understand that those are consumers that are paying for every other volumetric charge that the utility company and the commission applies, all of your clean energy initiatives and all of your infrastructure improvement initiatives, all of those are incorporated into those same low-income bill. And in some cases, even the programs that are providing assistance to low-income customers are billed to low-income customers too. I mean, it's all rolled in there as well as part of the distribution cost. So when you accept the fact that these are customers that need and are entitled to the same opportunity to pay, even though their method and means of paying would be different than a Mrs. Jones that's very wealthy. Or then you understand, the regulators understand the importance and the benefit of creating solutions that are efficient and that work for everybody in the service territory. And it's the kind of thing that it really is a critical component for regulators' overall work to make sure that all consumers within a service territory are benefiting in the same way from the services that all customers in that service territory are paying for. And it takes time. It's not something that commissioners and even other members of the staff and other regulators are knowledgeable about right away. You have to invest in it, and in order to become more experienced, so that you know exactly why the regulations are the way they are and work the way they work, and why the utility companies take the actions they take. Now, when you understand that, then it's very easy to talk about solutions that can apply to all consumers.
Well, thank you for that. Shelby.
Yeah, and I just wanted to add in there and say while there is currently a low subset of consumers who may be wanting this more diverse or flexible payment options, it is a growing subset, especially when you think that now the new generation of consumers are college students who are used to tech and accessibility and convenience and all of these options. Like, you can send your mom for Mother's Day through just a text message, some money through Apple Pay. So I think that the idea that it's not a necessity now is forgetting about this next generation that is so aware of all of their options for paying and receiving a service, that it's not thinking far enough in the future and is forgetting of this new wave that could be coming and potentially causing some hurdles with educating this next generation on payment options. So I wanted to put that out there. And then I also just wanted to talk about how, yes, customers are paying for contracts for the billing vendor, but this also, and they're going to be paying for that for some time. But while customers are paying for that, it also gives the utilities some time to actually look at, once this contract sunsets, what are some potential opportunities? Who are some potential partners that we can work with to diversify these payment options? So I definitely think that, yes, while there are a lot of barriers in place, a potential solution can say, hey, while we're stuck in this contract, let's have a task force, let's have some type of working committee to look at how can we diversify our payment options and really prepare for this next generation of consumers who are going to not only want but expect this diversity in payment.
Yeah, I just want to say one thing on that. We did do demographic research as part of our review, and I think the numbers have only gotten better. At the time, it was about 55% of customers were under the age of 50. So we didn't look at kind of the stereotypical low-income customer as being a retiree on Social Security. It was a single mother under 30. So they are digital natives, and I think we should have services that recognize that. That's the majority of customers.
I think, Corey, I'll let you say, are there any examples of utilities who are, upgrading their infrastructure to kind of develop what we'll call a more flexible customer engagement strategy that you want to highlight?
Yeah, I would say, of the work that we see within, I would say within our space, customers or utilities are investing very heavily in customer engagement platforms, mobile experiences, omni-channel platforms to meet customers in their channel of choice. Because what research has shown, and it's, I would say, consistent across the board, is that not all customers want to engage in the same channel. Low-income customers oftentimes will have challenges with either home internet or just access to laptops. But high percentage have mobile phones. So we've seen, utilities be successful in engaging in a text-based relationship with, with their customers, or in other cases, a responsive mobile capability as well. We see, a high percentage of low-income customers pay their bill via a mobile responsive web capability, and that's pretty consistent across different pockets of the country. So I know we're short on time. That's the quick answer.
Wonderful. As we wrap up, there were a number of questions, and I think we could actually spend far more time going through some of the nuances to the answers. One of the things I just want to highlight is that one of the reasons we also focused on payment structures is that as more and more Americans, have gig economies, we see more and more articles about an Uber driver who earned, $100,000 last year and $17,000 this year. One of the reasons that this is important is that people have, when they have the cash, we want them to be able to make sure that they can make payments. And again, it is decision making. We talked, there's a great discussion in the chat going on about what are you giving up to make utility payments. And so I'm going to ask each panelist just to spend 1 minute on what are 1 or 2 recommendations you have that this group, commissioners, staff, state energy offices might be able to take in the next 3 to 12 months to help support this, engaging customers along the payment structure. And I'll start with Shelby. You're on my left.
Okay, great. Yeah, I think for me, payment structure is important, but also what are we doing to ensure customers can afford to pay their utility bill? A little bit of a discussion that we had in the Q&A chat was, what are some of the risky behaviors that customers are engaging in order to pay their bills? One that's widely accepted is customers foregoing heat and cooling in order to pay their bill. Another one that I engaged in when I was younger in college and poor was selling plasma from my body to get a gift card to pay my utility bill. So I definitely think just the concept of saying, how can we make sure in these next 3 to 12 months, I think the number one thing that, people, the audience in this room can do is make sure we're answering those top questions that customers are asking, which is, how much time do I have until I am being turned off? What is the minimum that I need to pay to prevent being, spiraling through this dunning cycle? That last slide that I showed in my presentation, having something like that on utility websites may seem super, super simple, and maybe even unnecessary, but that allows customers to be more flexible and moving around their money, especially as utility bills are on that rise and customers are carrying more debt. So that would be my top recommendation, is requiring utilities to be extremely transparent, clear, and direct about the collection schedule and disconnection process, and then also requiring utilities at every time they're interacting with customers to reiterate the programs that are available, to reiterate options to reduce costs and reduce burden that customers are carrying, so you don't have to engage in that risky behavior.
Wonderful. Moving to Kevin.
Sorry, as a mute. My big thesis in working through light bill, and I've done this in other projects as well, is there's a lack of focus on design, and especially user experience design, in the way that we develop products for certain constituencies. And we found that just that motivation ability trigger was such a powerful thing to keep coming back to. There aren't really enough well-designed services that we've developed to really deal with this problem. I think providing information is great, but one of the things that's been said and shown is that customers aren't taking advantage of available programs because they don't know about them or whatever it is. They need to be integrated into and not separated from payments. That is the principal reason that somebody is connecting with the utility. So they're there to pay their bill. If there's an energy efficiency program, it should be salient at the point that they're paying their bill. if there is a subsidy program, it should be salient at the point they're paying their bill. We rely a lot on programs that are over here or over here or over here and doing their own marketing, and they're not really designed to be integrated into the main experience of working with a utility, which is actually paying their bill. So that is really what we focused on, and that's what we found in our proof of concept and what we really strive to design. How simple can we make this? Can we abstract all these decisions away from the user? Can we give them a trigger to make an immediate decision to do this or that or the other to get them on the right track?
Thank you. Corey.
I know we're at time, so I'll do this real quick. But I'll piggyback on one of the things that Kevin said, and I know it can't be done in every case, but we have seen utilities be successful in auto enrolling customers in programs that low income customers qualify for automatically. Take advantage of that. Don't make it just a one-way process, and also creating a one-stop shop for solutions via every channel. I mentioned before, the omni-channel aspect, having that accessibility across various channels that that low-income customers have the opportunity to effectively engage with their utility is also critically important.
Wonderful. Thank you. Commissioner Linton.
Sure. This has been a great conversation. I got 3 quick suggestions for commissioners and for other parties that are interested in moving this issue forward a bit more. First, for commissioners, I'd encourage you to learn a lot more about how the payment processes work. You can listen to webinars like this one, but you can also join the NARUC Committee on Consumers and the Public Interest, chaired by Floyd McKissick from North Carolina. They meet 3 times a year, and they also have other events during the year. And so you should certainly engage there. Within your own commission, you should make sure to encourage your staff to be a part of some of the NARUC staff subcommittees and also to participate in these webinars. And as a commissioner, I'd encourage you to find your consumer affairs office. Every commission in the country has one. Go there and take a day and listen to calls or engage with consumers to learn a little more about what's actually happening out there. And you will hear consumers contacting your office with concerns and comments about different issues that are occurring in the industry in their service territory. It's a fascinating way to learn a lot more about the industry in a very short period of time. And you will get an earful, believe me. With regard to a longer term solution, it's really important to spend a lot more time learning about why the utility companies operate the way they do, and making sure you're familiar with how the commissions operate, understanding the regulatory process and the administrative process. Commissions have the authority to regulate utilities because of constitutional and statutory powers that are given to them by their state governments. So there are some things that they can do right away, and there are other things that require processes that they have to follow. And they might seem, in the digital world, they seem very cumbersome. But I can tell you that the digital world is not really that new. It is new, but not that new. And there are some things that should take a little time to change. And so that once they are changed and done, everybody can benefit from them evenly, as opposed to some parties benefiting and others paying for it. And so there are procedures that have to be followed, and commissions will follow them because they're statutorily and legally required to do so. So you should be very familiar with them as a commissioner, as well as parties that are interested in moving these issues forward, because you're really building the steps to get there in the long run, and it won't happen overnight. But I believe panels like this are really how you get it started. So I was happy to be here today.
So I just want to say thank you again to all of our wonderful panelists. We literally could go on for another few hours talking and delving into some of the questions that are in the chat and answering. And I see really good discussion For those that are interested, again, we will make this webinar recording available, and we'll send that out to the list once we know where it's going to be hosted. If you are interested in kind of learning more or connecting with our panelists, feel free to reach out to RAC directly, to myself, drop me an email, or go on our website, and we're happy to connect people to learn more about payment systems, structures, barriers. I think one of the things you've seen is there's a lot of research. I saw Shelby and I think Kevin posting several articles and research articles in the chat. We have several of our own articles on our website as well, but happy to make connections to continue to push forward as we make the transition to a clean energy, affordable clean energy future. So thank you everyone for joining us today. And with that, we're going to sign off. Have a wonderful weekend.